What's happening, everyone, and welcome back to Amazon Insights. The news cycle never stops, and today we've got a rapid-fire rundown of the most crucial updates you need to know. Get ready, because the game is changing and you're getting the inside track right here, right now. We're diving into major moves in the tech world, shifts in AI strategies, and what it all means for the future. Don't miss a second. First up, a significant talent acquisition that could reshape chip development. Then, we're looking at an expert's take on the AI race, pitting giants against each other. We'll also uncover a strategic hire aimed at boosting in-house capabilities. And finally, we're exploring how these moves signal a new era for cutting-edge technology. Stick around, you won't want to miss this. Make sure to hit that subscribe button and ring the notification bell so you never miss an update. Tech talent shift: ARM hires Amazon AI chip expert. A major player in the chip design industry has made a significant move to bolster its in-house capabilities, signaling a new era of competition and innovation. ARM Holdings, a company whose technology powers a vast majority of the world's smartphones and is increasingly influential in the data center market, has reportedly hired a key artificial intelligence chip expert from Amazon. This strategic acquisition of talent is aimed at accelerating ARM's ambitious plans to develop its own proprietary chips, a move that could fundamentally alter its business model and its relationships with industry giants. The expert in question is Raimai Sino, who previously served as Amazon's AI chip director. At Amazon, Sino was instrumental in the development of the tech behemoth's in-house AI silicon, including the Trainium and Inferentia chips. These chips are specifically engineered to handle the demanding tasks of training and running large-scale artificial intelligence models and applications, a critical area of growth for cloud computing and AI services. Sino's expertise in this highly specialized field is precisely what ARM is looking to leverage as it transitions from primarily licensing its intellectual property to directly manufacturing its own chips. This strategic pivot for ARM is a bold one. For years, ARM has relied on its robust business model of providing chip design blueprints and IP licensing, earning royalties on every chip produced using its designs. This model has made its technology ubiquitous, powering nearly every smartphone and establishing a strong presence in the server market, where it competes with established players like AMD and Intel. However, the escalating demand for AI-specific hardware and the immense potential of in-house chip development have prompted ARM to explore new avenues for growth. By aiming to produce its own chips, ARM seeks to capture a larger share of the lucrative semiconductor market. To support this ambitious goal, ARM has been actively recruiting top AI talent from across the industry. Beyond Sino, the company has also brought on board Nicolas Dube from HPE, who brings extensive experience in large-scale systems design, and Steve Halter, a seasoned chip engineer with prior experience at Intel and Qualcomm. This influx of expertise suggests a concerted effort to build a world-class chip development team capable of competing at the highest levels. However, this strategic expansion is not without its risks. ARM's move into in-house chip manufacturing could potentially strain its long-standing relationships with key customers who also rely on ARM's IP, such as NVIDIA and Apple. These companies are themselves heavily invested in AI chip development, and ARM's direct competition in this space might be viewed as a conflict of interest, potentially weakening its core royalty-earning business. Furthermore, the research and development costs associated with designing and manufacturing advanced AI chips are substantial, and these increased expenses could impact ARM's profit margins and capital efficiency. Despite these challenges, ARM's CEO, Rene Haas, has publicly stated the company's intention to invest a portion of its profits into building its own chips and related components. The company is also exploring the development of chiplets, smaller, specialized chip components that can be integrated into larger, more complex systems. This modular approach could offer greater flexibility and efficiency in chip design and manufacturing. Analysts, meanwhile, remain largely optimistic about ARM's long-term prospects. The stock currently holds a strong buy consensus rating from many market watchers, with an average price target suggesting significant upside potential. Year to date, ARM's stock performance has been strong, reflecting investor confidence in its strategic direction. Audience impact. This strategic hiring and ARM's push into in-house chip development could lead to increased competition, potentially driving innovation and influencing pricing in the AI chip market, directly impacting companies that rely on these components. This significant shift in talent and strategy is just the beginning. Next, we'll dive into an expert's critical assessment of where major tech players stand in the AI race. AI race analysis. Expert questions Apple and Amazon's AI narratives. In the rapidly evolving landscape of artificial intelligence, not all tech giants are seen as equal players. Doug Clinton, CEO of Intelligent Alpha and co-founder of Deepwater Asset Management, has shared his perspective on the current AI race, suggesting that while some companies are making significant strides, others, including tech titans Apple and Amazon, are trailing behind their peers in terms of their AI strategies and market narratives. His insights, derived from proprietary AI-driven models, offer a quantitative look at which companies are truly leading the AI revolution. Clinton's AI models have been actively favoring companies with demonstrably strong AI businesses, identifying NVIDIA, Microsoft, Meta Platforms, and Alphabet Google as the current frontrunners. In contrast, his models have been steering clear of both Apple and Amazon, citing their AI stories as a little bit weaker when compared to these leading competitors. This perspective suggests that, from a data-driven standpoint, the AI strategies and visible progress of Apple and Amazon are not as compelling or as advanced as those of the companies Clinton's models favor. The divergence in AI strategy is particularly interesting when considering Apple. While some, like Deepwater co-founder Gene Munster, believe Apple has ample time to develop its AI capabilities, leveraging its massive and loyal customer base, Clinton points out that Apple's AI capital expenditures have remained relatively flat compared to competitors like Google, Meta, and Microsoft, who have significantly increased their investments since 2021. Despite this, Munster argues that investor expectations for Apple's AI advancements are so low that even incremental progress could lead to a positive market reaction, creating a low bar for the company to clear. Apple's established ecosystem and user loyalty provide it with a unique advantage, allowing it to potentially enter the AI race later but still make a significant impact with a strong product, a strategy it has employed successfully in the past. Amazon, on the other hand, has been actively investing in AI, particularly through its cloud services and the development of its own AI chips, like Trainium and Inferentia. However, Clinton's assessment implies that the market's perception and the tangible results of these investments, at least according to his AI models, have not yet positioned Amazon as a leader in the same vein as NVIDIA or Microsoft. The success of companies like NVIDIA, with its dominant position in AI hardware, and Microsoft, with its deep integration of AI into its software and cloud services, sets a high benchmark. Clinton's analysis highlights a critical distinction: the narrative and quantifiable progress in AI development. While Apple benefits from the assumption that its vast user base will eventually translate into AI success, and Amazon continues to build its AI infrastructure, their current standing in the AI race, according to this expert's AI models, places them behind the pack of companies that have more established and aggressively marketed AI-centric businesses. This viewpoint from Deepwater Asset Management underscores the intense competition in the AI sector, where strategic investments, technological breakthroughs, and clear market narratives are crucial for establishing leadership. The market is keenly watching how these tech giants will adapt and innovate to capture the immense opportunities presented by artificial intelligence. Audience impact. Investors and consumers alike will be weighing these different AI strategies, as they can impact product development, service offerings, and the overall market valuation of these tech giants. While some tech giants are being scrutinized for their AI progress, others are making bold moves to enhance their own AI capabilities. Next, we'll look at another significant hire in the AI chip space that could signal major shifts in the industry. ARM poaches Amazon AI expert for in-house chip ambitions. ARM Holdings, the UK-based semiconductor and artificial intelligence design giant, has significantly bolstered its in-house chip development capabilities by hiring a key AI expert from Amazon. This strategic move underscores Arm's ambition to transition from its traditional role as a provider of intellectual property, IP, to becoming a direct player in the manufacturing of its own advanced chips, particularly in the burgeoning field of artificial intelligence. The acquisition of Remi Sino, Amazon's former AI chip director, is a testament to Arm's aggressive strategy to attract top-tier talent and accelerate its technological roadmap. Sino's expertise at Amazon was central to the development of the company's custom AI silicon, notably the Trainium and Inferentia chips. These processors are engineered for the computationally intensive tasks required for training and deploying large-scale AI models and applications, a critical component of Amazon's vast cloud computing and AI services infrastructure. By bringing Sino on board, Arm aims to harness his deep understanding of AI chip architecture and design to propel its own chip-building initiatives forward. This hiring is part of a broader effort by Arm to build a formidable in-house engineering team, evidenced by previous recruitments such as Nicholas Dube from HPE for large-scale systems design and Steve Halter, a chip engineer with experience at Intel and Qualcomm. Arm's strategic shift towards in-house chip production represents a significant departure from its long-standing business model, which has primarily revolved around licensing its chip designs and earning royalties. This model has been immensely successful, making Arm's technology the backbone of nearly every smartphone worldwide and a growing force in the data center market, challenging established players like AMD and Intel. However, the explosive growth of AI has created a compelling opportunity for Arm to capture a larger slice of the semiconductor value chain by moving into direct chip manufacturing. This move, if successful, could unlock new revenue streams and enhance its competitive positioning. This bold strategy, however, is fraught with potential risks. Arm's foray into direct chip manufacturing could create friction with its existing customer base, which includes major technology firms like NVIDIA and Apple. These companies are themselves leading developers of AI hardware and may perceive Arm's direct competition as a threat to their own business interests, potentially impacting their reliance on Arm's IP. Furthermore, the significant investment required for research and development, manufacturing infrastructure, and talent acquisition in the highly competitive AI chip sector could strain Arm's financial resources, potentially affecting its profit margins and capital efficiency. The cost of competing at the forefront of AI chip technology is substantial, and Arm must navigate these financial hurdles carefully. Despite these challenges, Arm's leadership remains committed to this strategic direction. CEO Rene Haas has outlined plans to allocate a portion of the company's profits towards building its own chips and related components. Arm is also exploring the development of chiplets, modular semiconductor components that can be combined to create more sophisticated and customized systems, offering greater design flexibility and performance optimization. These initiatives signal Arm's determination to innovate and adapt to the evolving demands of the technology market. Market sentiment towards Arm holdings appears positive, with analysts generally maintaining a strong buy rating and projecting significant upside potential for its stock. The company's stock performance year-to-date reflects this optimism, indicating investor confidence in its strategic vision and its ability to navigate the complexities of the semiconductor industry. Audience impact. This hiring and Arm's strategic expansion into chip manufacturing could intensify competition in the AI hardware market, potentially leading to more advanced and cost-effective solutions for consumers and businesses alike. As companies like Arm make significant strides in hardware, others are being evaluated on their AI strategies. Next, we'll examine an expert's critical take on where some of the biggest tech names stand in the AI race. Arm nabs Amazon AI chip director to bolster in-house development. Arm Holdings, a global leader in semiconductor design and intellectual property, has made a significant strategic move to enhance its in-house chip development capabilities by recruiting a top AI expert from Amazon. The hiring of Ray Sino, who previously led Amazon's AI chip initiatives, signals Arm's intensified focus on creating its own proprietary chips, particularly for the rapidly expanding artificial intelligence market. This acquisition of specialized talent is a key component of Arm's broader strategy to evolve beyond its traditional licensing model and capture a greater share of the semiconductor value chain. Sino's role at Amazon involved spearheading the development of the company's custom AI silicon, including the highly specialized Trainium and Inferentia chips. These chips are critical for Amazon's cloud computing services, designed to efficiently train and deploy large-scale AI models and applications. His expertise in designing high-performance AI hardware is precisely what Arm needs as it embarks on its ambitious journey to build its own chips. This move is part of a larger trend where Arm is actively recruiting experienced professionals from industry giants to build out its engineering prowess. Previous hires include Nicolas Dube from HPE, known for large-scale systems design, and chip engineer Steve Halter, who has a background with Intel and Qualcomm, further demonstrating Arm's commitment to assembling a top-tier team. Arm's strategic pivot to in-house chip manufacturing is a bold step that could reshape its business. Historically, Arm has thrived by licensing its chip designs and earning royalties on every chip produced by its partners, such as Apple and NVIDIA. This model has made Arm's technology ubiquitous, powering the vast majority of the world's smartphones and making significant inroads into the data center market, challenging incumbents like AMD and Intel. However, the immense growth and potential of AI have spurred Arm to explore direct chip production, aiming to gain more control over its technology and capture higher margins. This strategic expansion, however, comes with inherent risks. Arm's direct involvement in chip manufacturing could potentially create competitive conflicts with its existing customers, many of whom are also developing their own AI chips. This could strain relationships and impact Arm's lucrative licensing business. Furthermore, the significant investment in research and development, coupled with the complexities of chip manufacturing, presents substantial financial challenges. Arm must carefully manage these increased costs and risks to ensure the success of its new ventures, which could affect its profit margins and overall capital efficiency. Despite these potential headwinds, Arm's CEO, Rene Haas, has articulated a clear vision for the company, emphasizing plans to invest profits into building its own chips and related components. The company is also exploring the development of chiplets, a modular approach to chip design that allows for greater customization and integration of specialized functions. This forward-thinking approach indicates Arm's determination to innovate and adapt to the evolving demands of the semiconductor industry. Analysts generally view Arm's long-term prospects favorably, with a consensus, strong buy rating, and a positive outlook on its stock performance. The company's stock has shown strong year-to-date gains, reflecting investor confidence in its strategic direction and its ability to navigate the competitive landscape of AI chip development. Audience impact. This strategic talent acquisition and Arm's push into manufacturing could foster greater innovation and competition in the AI hardware sector, potentially benefiting consumers through improved technology and pricing. While Arm is making significant moves to strengthen its hardware capabilities, the AI landscape is also being scrutinized for its leading players. Next, we'll hear an expert's assessment of which tech giants are truly excelling in the AI race. And that's a wrap on today's essential updates. We saw Arm beef up its AI chip expertise by hiring from Amazon. Experts are weighing in on the AI race, with some major players facing scrutiny. Arm is also making strategic hires to boost its in-house chip ambitions. Plus, we've got an expert's take on who's really winning the AI game. Don't miss out on future insights. Hit that subscribe button, ring the notification bell, drop a comment below with your thoughts, and follow us on all social platforms for more. See you next time.